just give you a brief of the major guidelines that operate in this sector. And one by one, we'll deal with the major ones in the sector and then see how they converge. We will also see how they apply. So we'll get through the basics first, and then we'll apply them. That's going to be the general approach. If we feel that we're overshooting the time, then we will probably give you some assignments. But the idea would be to get the basics right. So the payment aggregator guidelines they came up in 2020, and the idea is that there is in a payment system is all players that are involved in a payment transaction. We will go back to the PSS Act also. But in a payment system, broadly, there are two players that interact a lot, and which you and I also interact a lot in a daily basis, which is a payment aggregator and a payment system. A payment gateway. A payment aggregator, as the word suggests, is somebody or is an intermediary who is involved in the transaction and is collecting data from the merchant or facilitating the transaction between the merchant and a customer. In plain language, it would mean that if I am buying something from a website, or if I am buying, say, from Amazon, the Amazon is the merchant, I am the customer, and when the payment link goes to like Razor Pay or something like that, that is the payment aggregator. So a payment aggregator will take money from me and will ensure that it goes to Amazon. That's the job of a payment aggregator, broadly. But there are a lot of nuances to it, so we will get into that. A payment gateway, on the other hand, is a mere technology platform and has no role to play in the fund transfer. So the distinction is that there is an entity that deals with the funds. If you touch the funds, you are aggregator. If you don't touch the funds, you are just a technology provider. You are a gateway. Gateway, as the term suggests, is literally just a technology backend whatever situation, but a gateway does not have any control over the money. A gateway does not touch your money. That's it. That's the distinction that you have to remember. So the PFPG guidelines then talk about, who is a payment aggregator, how are they registered, what are their requirements, who is the payment gateway, what they can or cannot do, and there are a lot of other nuances in what situations that these guidelines apply. How will they manage the data, the card data that you put in or the payment data that you put in? How are they going to manage it? Where is it stored? And those then delve into different other regulations. So this also deals into other things. We'll come into it. Then there are the PPI directions that are issuance of prepaid instruments. So prepaid instruments would be basically, in a very crude language, would be your vouchers, your voucher cards. So if you purchase a prepaid instrument, that means the instrument or the voucher that you receive is paid for, but it can only be used with a particular vendor. Okay, so that's a prepaid instrument. So you buy a gift voucher, you buy an Amazon gift voucher, you buy an Uber gift voucher, you buy a Zomato gift voucher. Those are prepaid instruments. Now these prepaid instruments also can be of two different kinds. One could be that you only, encash them with a particular, merchant. Those are non-transferable prepaid instruments. You only get like an Amazon voucher. You can only encash it at an Amazon. You get a Marks and Spencer voucher. You only encash it at Marks and Spencer. Good Earth, all of that. You can do it once. There are other prepaid instruments that are generally usable in sort of trade. They're more business friendly, more trade related. That can be used at multiple outlets. They're not very consumer centric, and you can withdraw cash against it. So say, for example, in a business transaction, if I'm buying goods, a consignment of goods, somebody gives me a prepaid instruments, in terms of payment. Once my consignment is delivered, the prepaid instrument becomes active, and against that prepaid instrument, I can go to a bank and get my cash. very, very crucial. Those are prepaid and transferable. So as the name suggests, you can encash them for cash. They earlier had a smaller 10,000 rupees, some sort of a limit, but now that limit has been increased and to make it more business friendly. And in these kind of transferable PPIs, there is also a KYC requirement because, of course, you can encash them for money and all of that. So the more nuanced instrument gets, the more compliances it sort of draws. While you can obviously, it's very easy for anybody to buy a gift voucher for a particular brand. There is no KYC requirement for that because that scope is really limited. So those are prepaid instrument transactions. Another thing that we all deal with on a day-to-day basis are KYC directions. So when you're trying to open a bank account, when you're trying to get a card, when you're going to get a credit card, when you're trying to get a loan. So those kind of things, like what is KYC, know your customer? How does that happen? So in that, there will be a KYC agent sometimes who comes to you and collects your Aadhaar number, PAN number, puts that data, matches what you tell him with your Aadhaar, it collects that data, matches, verifies your identity, that you are who you say you are, all of that. And now we are also seeing eKYC. It generally is in a video form, and it's sort of a 3-minute long process where you are doing, and there is a technology behind it which is doing your KYC online. So all of this process is governed by the KYC guidelines. How, this KYC happens. If somebody is using KYC, what do they have to do? If they are, using Aadhaar for verification, if they're using Aadhaar-based verification, then it also intersects with the Aadhaar Act, how that data is collected. It also goes into real nuances as to how is somebody collecting your data? What kind of a machine they're using? What kind of a technology security they're using? Because they have control over your identification or your financial information. So in terms of technology or very technical core compliances, this is where it gets really technical. So that's coming from the KYC directions. These directions also keep updating themselves in terms of how the technology progresses. So earlier, they only provided for like a normal KYC, document-based KYC. Then they provided, when the Aadhaar came in, so then they spoke about Aadhaar-based KYC. Now they talk about video KYC or, technology-based KYC where there is no real individual involved. So all of that. So with the technology that's evolving, KYC also, directions have also evolved. Interestingly, this is a sector where we also see a lot of fintech players coming in as players that are facilitating KYC. So there will be a startup which is now helping banks do KYC faster. Because how that happens, suppose you apply for a credit card online, while you can apply for a credit card online, somebody will come to your house, collect that, KYC information. You're going to have to put your, financials. You will have to give him some documents. You will have to put your thumbprint. So all of that is manual, and in the larger scheme of things, gets really cumbersome. And some may say that because there is an involvement of a human element, it also increases the margin of error. Now that's debatable whether you think the involvement of a machine takes away the human element and there is margin of error, whatever. But the idea is that involvement of, labor and, including more people in the chain increases the margin of error. So now, and of course, makes the process slower because he's going to come to your house, collect that data, send it, supply that form. You will also have to, print out 20 documents, so on and so forth. So it's also cumbersome for the user. So as entities are now coming up with eKYC, where they're doing KYC online. So that's a huge sector where you are seeing a lot of fintech players emerging that are, taking away this human element, this cumbersome element, and doing it themselves. I know that Federal Bank is using eKYC, and I also know that a lot of other, I think Cred and all are also using eKYC, so that's quite interesting. And this space will then also develop in terms of how non-banks doing KYC are to be governed. So that's also going to be there because until now or very recently, only banks were doing KYC. So they had a separate regulation, but in this case, non-banks will also be governed.